Fearless Families. This is Dr. Cheryl Schmidt, and welcome to the Fearless Family Health Podcast. In a world that is filled with fear, my hope is to bring you inspiration, information, and support to live more joyfully and more healthy. Come with us as we interview parents, doctors, and experts in all areas of health and vitality. Let's make you the master of your family's future. Hello, this is Dr. Cheryl Schmidt, and welcome to the Fearless Family Health Podcast today. Today, we are going to talk about money. We did an earlier podcast a few weeks ago on money mindset, and that's really where creating wealth and abundance starts. But in today's podcast, we're going to go a little deeper. We're going to talk about the nuts and bolts of finances, working with a financial specialist, and just how to start creating some wealth no matter where you're at. Whether you're still just getting out of college and have debt, or you're starting to have a family, or starting to build wealth in more typical terms of building wealth. Today, my guest to talk about this is Dr. Danielle Trego Finden. Dr. Danielle is a chiropractor, but her husband is a financial advisor, and they have been working on creating wealth within their family for years now. So Danielle is a perinatal and pediatric chiropractor in the Twin Cities, where she has been named a top chiropractor by Minnesota Monthly Magazine 2014 through 2019. She is Webster certified, an ICPA diplomate in process, spinning baby certified, and a BIRTHFIT Regional Director. She has additional training in DNS, perinatal mental health, breech balancing with Adrienne Caldwell, cranial sacral therapy with Lori Hendrickson and Deb McLaughlin. Dr. Finden graduated from Northwestern Health Services University in 2008 and opened her practice, Active Health Chiropractic, where she serves as adjunct faculty to the College of Chiropractic as a community-based internship supervisor. She has 2 associates and a satellite clinic at a prenatal yoga studio in her neighboring town. In addition to Active Health Chiropractic, Dr. Finden has flipped another practice and sold it for profit in under a year. She wrote A Guide to Alternative Chiropractic Technique, How to Keep Your Healing Practice from Hurting You, a chiropractic technique manual specifically addressing the unique biomechanical needs of the female practitioner. She has also developed an online associate training program called Associate Academy, providing personal and professional development topics accompanied by written exercises. On top of all of that, Dr. Finden is a mother of 2 little boys, an Ironman triathlete, and a relentless consumer of information on the pregnancy realm. As you can see, Dr. Finden has a lot of business and money expertise, and we will for sure gain a lot of insight and information on building wealth and financial management. So welcome, Dr. Danielle. Hi, Danielle. Welcome to the podcast. I'm excited to have you here because we're going to talk about money in kind of the next level. We're going to talk about creating wealth and how that starts and how you kind of build upon a foundation. So, hi, you want to say hi and tell people a little bit about yourself?
Hi, Cheryl, thank you so much for having me. I'm really excited to be sharing some information with your listeners today about exactly what you talked about. How can we take the fear out of financial planning for families and trying to help them build wealth, not just get out of debt? So that's what we're going to focus on today.
Cool. So what is your background, or where did you learn about this to start with?
Yeah. So my husband actually happens to be a financial planner, which was a second career for him. And so I sort of get a lot of my knowledge, obviously, from conversations with him. But I'm just a regular gal, leading up to my relationship with my husband. I mean, I always was totally mystified by anything when it came to money management. I didn't have habits of accruing a bunch of credit card debt, but I certainly didn't know how to build wealth until I met him. And so that's sort of my lens that I look through, is the wife of a financial planner. So
yeah, I have a similar, my husband's a DC, but he also does most of the financial planning, and he does stock trading, and he does all, pretty much manages the investments that we do. I kind of watch and see what's going on. And I've learned from him. So I'm glad to bring this because a lot of my listeners are women. And I think that's the case in a lot of people's relationships is that, the guys are the ones that seem to kind of take charge, not all the time. It's, obviously not going to be true for everybody, but, that's what I see probably the majority of the time is that the men are the ones who do the financial planning. So I want to kind of bring this to the women so they can understand. And if they don't have a partner or they are relying on themselves to do it, that they have an understanding and to take away the fear and that, yes, you can do this too. It's just
absolutely.
So what
and
are your
to empower you to get into a situation that, we certainly run into a lot of people that if in the relationship, that's sort of how it goes, it's very divided, that maybe, the wife, the mom, one of the partners is not really taking control of what's going on with the finances and maybe not even fully aware of what's going on with the family's finances. And then what if your partner that does manage all of that, all of a sudden you find yourself in a bad circumstance where that partner is no longer your partner through divorce or through death or any other tragedy of circumstances, right? And you have no idea what the financial picture of your family looks like. And now you have to manage it and you have no idea what you're doing. So let's try to give people some tips so that they can empower themselves to not get put in that situation. And if you are in that situation currently, here are some things that you can do to try to take the bull by the horns, so to speak, and take control of what's going on.
Yeah, I think that's key too, because so many women live longer generally than men do. So there usually come a time where all of a sudden they have to take control of their finances. And I want to just preface that we're doing this. This is kind of like a health podcast of Fearless Family Health. And money is so important when it comes to your overall health and wellness. And I really think building a good nest egg, building a retirement is just going to set you up for having a less stressful life, a healthier future, less worry about money and long-term health issues, all that stuff. So this is such an important topic. I'm so glad that we're talking about it, especially really targeting women, but men too. A lot of men don't know how to manage their money. So yeah, this is going to be a cool topic to talk about. So when someone maybe isn't they're out of debt, they have some money that they're coming in, what are some of your biggest tips for having them take that and use that money? What do they do with that money now that they're starting to create some wealth?
Yeah, this is really, I think the first step for a lot of people is realizing that you don't have to have a lot of money to invest in order to start investing, right? And I think it's sort of one of those, as you're preparing to grow your family and have a child, you think, I just want to save a little more money. I want to take one more international trip. I don't, how can you actually be ready and prepare for that? You never will be. You just have to dive in. So same thing with finances. You can't come at it from an angle of, I need to accrue a little bit more wealth before I start investing or before I start meeting with a qualified financial professional. It's the opposite, really. When you don't think that you have enough money to be investing is exactly when you need to be meeting with a qualified financial planner, because they are going to help you figure out how to turn what you currently have into something bigger. And then you start growing from there. So the first step really is to find a qualified financial planner. And the best way to do that is ask your friends. Who do they use? Who's great? You might have a family member that has a financial planner that they could recommend to you. And I recommend meeting with a couple. So just like anything, meet with one, have them put together a plan for you, seek a second and a third opinion. Yes, it is a little bit of work on the front end, but in order to find somebody that you mesh well with and that is going to create a plan that understands your family's goals, they'll help you put together a plan that's going to work for you. I think a lot of people sort of default to, I have a 401k from my employer and it's, just managed by my employer. And you have to understand that their quote management of that portfolio is not specified to you and your family's needs. They are managing the entire corporation's finances exactly the same. And what we know is that your household situation is different than my household situation. I could be sitting across the aisle from somebody who has, babies and toddlers at home, and I might have college age kids. That obviously our financial picture is going to look very different, and what our plan should be this year, next year, and going forward. And so to be managing it exactly the same does not make any sense. So just because you have an employer 401k, for example, it is important to have somebody else managing that for you. So I would say that's the first step, is trying to find a qualified financial planner there, and then making sure that you're diversifying your portfolio. So what does that mean? We hear that term, but what does that really mean? And it means a lot of things. It doesn't only mean, when it comes to, we need 10% in international stocks and 30% in local, you can get down to that nitty gritty. But when I say diversify your portfolio from sort of the beginner standpoint, I'm just diving into managing my finances. What I mean by that is, don't put all your eggs in one basket with a 401k, right? You need to have some other options. So there are things that a qualified financial planner will talk to you about, and some tips that I can give you just based on my family situation, that it might look a little bit different for each person. But of course, if I only have a 401k, what if the market tanks, or what if something happens in my family situation and I need to start pulling money out of that before retirement? What are the penalties there? What kind of tax implications are there? So there are different accounts that are pre-tax versus post-tax. You pay the tax before the money goes into the account versus you pay the tax when you withdraw the money. We know that tax brackets are changing all the time. The projection and the prediction is that whatever money you have in an account that you're going to pay taxes on when you draw it out in retirement, you will pay more in taxes at that time than you will pay currently in this time. And so that doesn't mean only invest in pre-tax things where, so I've already paid the taxes and now I'm going to load all my money into this account where I've already paid the taxes, where there will be no tax implications or penalties to pull it out later. You need to diversify. And then you need to understand what the implications are if you do have to withdraw that money. And then planning for, maybe there's something else that doesn't even include what we traditionally think of as a retirement account, that I can be accruing cash value, that I don't necessarily have to wait until retirement to pull that money out. And so the biggest suggestion that I have, what that looks like in our family situation, is universal life insurance. Some people think that life insurance is, you just pay all this money and then you never get any of it back, but it actually accrues cash value. And so, you could use that to pay for when your children get married and you have a wedding to pay for, or you want to gift to your child a down payment on a house when they are grown and out of, moving out of your home. So those are options that you have. Or you want to do some renovations on your home, and instead of taking out a home equity line of credit and paying the bank that interest, what if you could borrow that money from your own retirement or life insurance accounts and pay the interest back to yourself? So I know that that's sort of like a heavy start where we just really front loaded a whole lot. And then I'll just also throw out the caveat that for me, I am a small business owner, so I'm also an employer. So for me, I have to think about, what can I do from the employer perspective to also save myself money on taxes? But then what can I be doing to help my employees build wealth as well? And so some of the things that I do may not immediately translate to some of your other listeners, but I'm certain that you have plenty of listeners that are also small business owners. And so knowing that you may have an accountant, that I think a lot of people, when they think about saving money on taxes, they think about meeting with an accountant. An accountant and a financial planner have very different long-term goals for you. An accountant really only thinks about this year and next year, and your financial planner is thinking about not just this year, but what that means for your retirement and what that means as your life trajectory changes and as your financial goals might change. Whereas your accountant doesn't necessarily have the ability to look that far ahead. It is not their job to tell you how to be investing money in order to save money on taxes. So if you do have a situation like that where you can have an accountant that you know, like, and trust, and you can have a financial planner that you know, like, and trust, and those two entities can start talking to each other, that is really a beautiful relationship there that is going to help you build wealth, because you start to save a lot of money on taxes, and you can invest that. The money that you otherwise would have paid to the government actually goes into retirement for you. And what we know about retirement is that that money is exponentially going to grow. And so whatever money I saved on taxes this year goes into my retirement. And when I retire, that money is not just the money that I saved this year, right? We've got compounded interest over the course of 10, 20, 30, 40 years. And so that $3,000 or $4,000 I saved on taxes turns into $20,000 by the time I retire or more.
Yeah. And you really have to look at that long-term goal, that long-term plan, which sometimes people have a hard time looking at that long-term goal. And just everything you said is like, it's a lot. So somebody who isn't using a financial planner, like that, just like, oh, like that's a lot of stuff to like take in right now. They probably feel like overwhelmed. But I think the key is like, look, you can get a financial planner and they'll help you with all of these things. You don't need to understand it all yourself. You don't need to do it all yourself, but you do need to know where your money is going and understand it. And they will help you through that. Yeah. And so I think
exactly. So starting there, let's try to like distill it down for people so that they're not getting that sense of overwhelm. First and foremost, find yourself a qualified financial planner. Again, can't stress enough, get multiple opinions so that you find somebody that you are going to trust is going to mesh well with your family. The best way to do that, again, is by direct referral. So talk with your friends, talk with your family members. Social media is a great way to reach out and say, who has a financial planner that they love? The best part is that a lot of financial planners can be licensed in more than one state. And so you don't necessarily have to be in the same state as a financial planner. You might have a friend or a relative that has a really great referral for you out of state, and you could meet virtually with that person if they're licensed in your state. And some of them, if that's the right fit for you, even if they're not licensed in your state, they can get licensed in your state so that they can help you manage things. That then sort of segues into my next piece, is that, I had mentioned earlier about having a difference between, maybe one of your coworkers in a totally different financial situation than you, and maybe looking at, just the easy example of, I have little kids and I'm paying for daycare, so I have a lot of money going out there that I don't feel like I can be investing, versus I have a child that I'm preparing to send off to college and I've been saving, but what strategies should I be doing now as we're preparing to start paying a lot of that money out for college? Those are two very different situations. And I think, unfortunately, a lot of families find themselves in a very reactionary role when it comes to those things. I like to try to live my life more on the proactive side. So what can we do to plan for that? And so meeting with your financial planner on a regular basis, that can look like annually or biannually or once every 5 years, depending on where you're at in your life. But they should know what your long-term goals are, and they'll talk with you about that. And then, they'll put it on their calendar that they should reach out to you. But I think for a lot of people, if you're thinking, okay, well, gosh, that's one more thing for me to do, how am I even going to remember to do that? Just a little cue or a tidbit that I think a lot of people choose to maybe not even think about money until tax time. And then they go, oh, I'm getting a big refund, or, oh, shoot, I have to pay in a bunch of money. And so you're thinking about money in that time. And again, that's very reactionary. So for me, I like to think about my money and what that trajectory is going to look like at the end of each calendar year. So I'm starting to think like in October and November, okay, what kinds of things should I be doing right now to plan for the end of this year to better strategize how I'm wrapping up what happened this year financially? Where should I be moving money around into different accounts when it comes to retirement? How should I be weighting the pre-tax dollars versus the post-tax dollars? And how can I be saving money on taxes? So those are some good things if you meet with a financial planner, to just say, I'd like to sit down once a year in October or November and talk about those things with you, so that then when I meet with my accountant or when I sit down to do my own taxes, I'm very clear on what that plan is actually going to look like.
So I have a quick question, because I know some people are probably asking, if they don't have a financial planner yet, how, and they maybe are feeling that they're struggling to meet their bills, or maybe just have a little bit of extra, like they're just in that, oh, do I have extra money to hire someone to help me with this? So how do they pay for a financial planner?
Excellent question. I'm so glad you asked. So I think, again, yes, this is a big caveat for people where they think, I don't have money to pay somebody to do this. Guess what? The beauty is many of them are going to get paid based off of the return on the investment that you give to them, which means I don't pay my financial planner anything directly. What I do is I put money for my retirement into, let's say, a Roth IRA account. And maybe I have a traditional IRA account that my employer has given to me. And from there, that accrues interest. And there are some fees that come out quarterly or annually. That is how your financial planner gets paid. So they are getting paid only on the interest earned on your accounts many times. It depends on the account. Sometimes there are fees, but generally speaking, whatever those fees are is less than the amount of money that you're earning by having those accounts. So if you do find yourself meeting with a financial planner that is operating in a different way that you don't feel comfortable with, again, seek a second opinion. So just sort of quelling that fear from the outset that you don't have to have money to meet with a financial planner. You don't have to feel like you have money to meet with a financial planner. In fact, they're going to help you realize that, okay, maybe for $35 a month, we can get you a life insurance policy that's going to start accruing cash value. And then you can use that in retirement. You can use it for all the other things I said. And you go, okay, well, that's fantastic. But where do I get that $35 a month? I don't know. How often do you go out for coffee? How often do you go out for dinner? Right? How often could you do a date night with your significant other where instead of going out for dinner and spending $100 on a meal, could you do something that's going to cost you half of that for your date? Go for a walk around a lake or go for a hike somewhere, or, you know, do something together that looks a little bit different so that you are saving that money so that that can go right into the life insurance plan. Your financial planner will help you figure that out, how to come up with that money. And here's the beauty of it all is that we are reactionary by nature. It's really hard to be proactive. But when you establish good habits of being proactive and saying, I'm going to put $35 a month that gets auto debited out of my account, and that goes into retirement savings for me, whether that be to a Roth IRA, to your life insurance, to a traditional IRA, whatever that's going to look like for you. It's nice for me to say at the end of the year, I'm going to max out my contribution to my Roth IRA, which, you know, in my household looks like over $4,000. So it's a lot harder to come up with $4,500 at the end of the calendar year and just shove that to the Roth. And that feels like a big gulp, honestly, right? You go, ooh, that was a lot of money to shell out all at one time. However, if you're putting $35 a month into it, right, could that grow much easier and be a smaller pill to swallow, so to speak? And so when you can automate and when you can create a habit, it makes it so much easier.
Yeah, the automation and the consistency, and just taking even the thought process out of it, like having an auto debit, you just know it's just like another bill that you have to pay. You know, it becomes something that is automatically deducted, and really you don't miss it as much as, like you said, the big chunk if you do it all at once. And it's like, oh my goodness, that was like, whether it's $300 or $3,000, you know, depending on what you're investing, it can be
exactly.
So,
and we all have extraneous expenses that we could probably cut back on. I mean, just think about how much money do you pay for your television services? How many different streaming are you paying for? Spotify and Netflix and Hulu and Amazon, and you're paying a cable company, and you're paying for your internet. And here's the thing is that in your household, I'm not here to judge you and say you shouldn't be paying for any of those things. It's just a relativity and saying, is this important to us? And maybe you say, like, I absolutely need these things. These are necessary expenses for my family. So I cannot cut back on those expenses in order to contribute to retirement, but maybe it's as easy as a phone call to your internet service provider to say, hey, I'm thinking about switching companies. What can you do for me to lower my bill? Like, eye-opening, right? And all of a sudden you're saving $35 a month on your internet bill. Boom, that goes right into your retirement. That's where that money just came from. Sometimes you just have to get a little creative, but it's there. The money's there. Really, the other piece to that is the money is there and you're going to spend it either way. What are you spending it on? So are you spending it on investing in yourself and building wealth for your future? Or are you investing it on a dinner with your significant other, your cable bill, coffee, every morning before work, those kinds of things? However the money comes to you, you're going to spend it. But if you can automate and create a habit that you need to pay yourself first, it makes it a lot easier.
So I want to talk a little bit about debt, because everybody right now seems to be like, we need to get out of debt, completely out of debt before we can do any kind of investing or putting money. Like they want to. So let's talk about debt. Good debt, bad debt. Is there such a thing?
Yeah. Oh gosh, that's a really loaded question. So here's what I would say about that is I think that is really in the eye of the beholder, right? To me, I think that no debt is good debt, but there's necessary debt, right? So would I prefer to not have a mortgage on my home? Would I prefer to not have a car loan? Would I prefer to not have student loans? Yes, I would prefer that. Are those some things that in different periods of someone's life that might become necessary? Sure. And so I don't think we need to look at it as, well, I need to pay off all of my student loans. I need to pay off my mortgage. I need to pay off whatever it is, even credit card debt. I mean, the vast majority of Americans have very high levels of credit card debt. And so again, to think about, I need to pay off that credit card debt before I can even start to save that $35 for myself. Again, you have to look at what is the interest rate on that credit card. Sometimes a simple phone call to your credit card company to say, can you lower my interest rate? All you have to do is ask. Sometimes they'll do it for you, right? What's the worst that's going to happen? They're going to say no. And then you're no worse off. So thinking about what is the rate on that credit card, and then thinking about, okay, what age am I and how long do I have until retirement? And if that money doubles every 7 years, how much money am I actually making by paying myself first versus paying off this credit card? Is that making sense? Yeah. So you look at, let's say you have, I don't want to overwhelm people and like actually talk numbers. I'm not I'm a science person. I'm not a math person. But if we just try to like give people a little bit of math to make it somewhat easy, you say, I have $1,000 of credit card debt and the interest rate on my credit card might be 10%. But I'm going to earn at least 7.5% interest on an investment. And 7.5% is very conservative. If you are in an aggressive allocation for investing, you likely are getting at least 12.5, which 12.5 automatically more interest than how much you're paying to the credit card, right? So you're already making money. But let's say, just for semantics, that you're making less money today on the interest rate that you put into investing for yourself versus what you would if you pay off that credit card debt. But you have to remember that 7 years from now, the amount of money that you've put into investments for yourself doubles. And so now all of a sudden that 10% fee on the credit card seems a bit smaller because your money is exponentially growing in your investments. So again, meeting with a financial planner is going to help you create a plan to pay down that debt while at the same time you're building wealth. So it does go hand in hand. And I think you can't look at it as I need to get out of debt first before I build wealth. Because if you look at it that way, you'll never get to the building wealth phase, right? Because they're always, you'll buy a new car, you'll buy a different house, which then you take out a mortgage. You know, there's always going to be something. So there is absolutely a way to decrease debt while building wealth at the same time.
Yeah, and there's investments you can make that you would be like if you bought real estate and you took a loan out to buy real estate and made it into a rental. Well, yes, you're going to have debt on that real estate, but someone else is paying rentals. So, but if you wait until you get all that debt paid off before you invest money, then you're just chasing your tail. You're not really going to be creating that wealth. So there's times too where some of your mortgage can be tax deductible, your student loan can be tax deductible, the rates are really low. It just doesn't make sense to be paying off those low interest rates with tax deductible, perks to just pay them off and not be paying yourself, where you can be making, like you said, 10%, 12.5% of a return, plus that money's doubling. So
So personally, for my situation, I do have student loan debt. And we actually did the math and drew it out and looked at the trajectory of if we put extra money into paying down that student loan debt faster versus I put it into a simple IRA for myself, at what point would it match, or would that simple IRA supersede the amount of money that I have paid on my student loans? And because of interest rates, it actually made more sense for me to just make the payment to the student loan as opposed to making extra payments to the student loan. And instead of the extra payment to the student loan, that extra payment, boom, goes into a simple IRA for myself, because I'm actually building wealth faster there than I am paying off the debt. Does that make sense?
Yeah, it makes perfect sense. And I think a lot of people are so concerned about paying off all debt that they're not looking at the actual math and the numbers and how you can be creating that wealth like you talk about. We do the same thing. We have a lot of our debts are paid off, but we do have some investments in properties. We do have one student loan of the two of us that we pay the payments on, because like you said, you can make more money investing that money into IRAs and other rentals or other properties. So it's not as simple as pay off all your debt and then start creating, wealth. It doesn't.
No, and here's the thing is that the sooner you start building wealth for yourself, remember it doubles every 7 years. So the sooner you start, the more wealth you have in the end, right? That's like the big secret. So if you wait until you pay down your debt, every year that goes by, you're shooting yourself in the foot. Because if I started saving money when I was in my 20s, I started saving for retirement in my 20s, that wealth builds, even if I'm only paying a very small amount, that wealth builds by the time I retire. I could put less money every month if I start in my 20s than if I start in my 40s. I could put 3 times as much money into retirement if I start in my 40s. I'm going to wind up with the same amount of money in the end. But it feels like less when I'm in my 20s, right? To say $35 a month, $50 a month, whatever it is. And guess what? Once you create that habit, then people say, well, if it's the same amount of money over time, what difference does it make? I'll just start building wealth in my 40s then. Wrong, because what happens, you start building that wealth in your 20s, but all of a sudden now in your 40s, you would have been paying more money. You're still going to pay more money to your retirement because now you have more income. And now you've quadrupled how much money you actually are going to save.
Yeah. And this is such a great topic for kids. I mean, kids need to be learning this stuff in middle school, high school, and start saving money, because if they start creating wealth in their teen years and early 20s, it just sets up such a more optimistic future for them. And just like it does for anybody. But if you can start at that age, it's a huge stress off of people, and that affects, like I want to talk about money because it affects people's health and wellness and prosperity so much, and no one talks about it really. Or talks about
and you should like go out to dinner with go on a double date with another couple and talk about money. I mean, how many raise your hands if when you were courting with your significant other, if you sat down and had real conversations about money on multiple occasions before you decided to enter into a long-term relationship? Most people don't. And I think that does need to change, like you said, right? So I get that I'm the rare exception, that my partner and I, we definitely had those conversations early and often throughout the beginning of our relationship, because we wanted to make sure that financially we were going to be compatible. What are our long-term goals? What are our spending habits? Those kinds of things. But yeah, why is it taboo to talk about money? And you want to know what? The more you talk about it, the easier it is to build more wealth, and the more easily money flows to you. So yeah, why not? Have a money date with your significant other, have a money date with another couple. And everyone has probably heard that adage about you are the sum of the 5 people you spend most of your time with, right? And so what does that mean when we talk about money? I would say, look at your circle of friends, and there probably is a couple of people that you can identify that you think, gosh, those people seem to really have it all together financially, or those people definitely are building a lot of wealth. Maybe we should go out to dinner with them and ask them what they're doing. Ask them who their financial planner is. Ask them what strategies they're using. They probably would be very open and love to talk to you about those things. You obviously don't have to talk actual numbers. You just talk strategies. And again, what's the worst that's going to happen? You invite them out to dinner and they shut down the conversation, and you have a lovely dinner with friends anyways.
Yeah, I think it's a great topic. And so my passion is just creating empowerment for people, taking fear out of decisions that they have to make when it comes to their family, whether it's health, finances, relationships. So I want to ask you, what is your passion for talking about finances with people?
Oh, I mean, I guess passion about finances, I think for me, it really comes down to, and again, my situation might be a little bit different than other people's, but I know this is a very family-centered podcast. So many of your listeners have children. And for me, it really comes down to having children. And like you had mentioned, it is all about what kind of money mindset am I imparting onto them? Is it something that we don't ever talk about? Is it something that we feel uncomfortable or queasy about? Is it something that we have fear about? Or is it something that we really feel confident and we feel empowered? And are we passing that on to our children? And then what kinds of good habits can we give to our children? So one of the things that we did in our family is, as soon as the child is born, we get a life insurance policy for that child. Now, my kids are still young. They have no idea what life insurance is or that they have a life insurance policy. What I will say is that we plan on using that as a gift to them when they are grown and out of the house, perhaps graduated from college, if that's the path they choose, right? To say, here is something that has been building wealth for you since the time you were born. And now you can use it to put a down payment on a house. You can use it to pay for your wedding. You can use it to continue to build your own wealth for your own retirement. Everyone's situation can change in a moment. And so just creating that as an option, I guess that would be my passion, is really what are we gifting to our children? And I think most parents come from a place of, I always want my children to have more than I had. And so this really is the greatest gift that I feel like I can give to them. And it's not about giving them $20, right? It's about that habit over time. We've been doing this since you were born. And here's what that looks like today, so that when that comes to them, they realize how much of a big deal that really is. And then I get to pass on a legacy to my children.
Yeah, it's awesome. So anything you want to say before we say goodbye?
I think we covered a lot. I guess just to maybe recap and distill it down, I think that diversifying your portfolio, again, is really important. And making sure that you have more than just one way to build wealth. And you had given a couple of, tips and tricks about real estate investing or rental income or things like that. I mean, those are great things to consider as well. And again, that might be a little daunting for people in the very beginning, but just tucking that away in the filing cabinet of your brain and keeping that as an option for maybe in the future if you're just getting started with this, but knowing that trying not to put all of your eggs in one basket and being aware of what your financial picture really looks like. Planning strategies are going to change and evolve over time. So when you are starting your family and you have small children versus when those children are going to college versus when you're nearing retirement, the way that you're managing your investments is going to look differently. Knowing that if you have an employer a retirement account, how that is managed does not change based on your family situation over time. And so you do absolutely need to have somebody actively managing that, whether you do it yourself or you hire a financial planner to do that for you and meet with them on a regular basis. And just know what your financial goals are for the future. A qualified financial planner will ask you, what does retirement look like to you? I think a lot of people don't think about what retirement looks like for them. They think about, I'm going to work and work and work and work until I retire. And then that's sort of the end. You say, no, that's really just the beginning. What do you want to do in retirement? Do you just want to continue to live your life exactly the same that you have, except now you have all this extra time because you're not working? Do you want to travel? Do you want to make large charitable contributions? Do you want to gift money to your children and your grandchildren? Do you want to be able to take your family on extravagant trips all together? Do you want to have a second home somewhere in retirement? I mean, these are all things that people can start to think about to say, okay, so if that's what my retirement goals are, what do I need to do today to start planning for that?
Yeah. And I think it's great to empower. It'll empower people. Once you get that plan, it gives you things to work towards, and it empowers you to take control of your money, which to me just lifts the stress and creates an optimistic, abundant future. So
absolutely. And knowing that you have a plan, right? So even if you currently have debt, you don't feel so anchored by that debt because you know that you actively are managing building wealth so that as that debt decreases, you have that wealth already built in so that you're not feeling the weight of that debt quite as much, right? It's not this dark cloud that just hangs over you. The debt doesn't have to be the dark cloud. It can be something that you say, yep, we're doing something about this, but we have a plan so that we know that it doesn't have to feel like an anvil on your shoulders.
Awesome. Thank you so much for sharing. And I hope that this gives some people some things to think about, and they go out and they find their financial planner. And if they don't have one already, and if they do have one, make sure they have the right one and make sure that they are looking at their future for not only themselves, but for their families. So Thank you so much, Danielle. And we will put any kind of contact information or resources that you want to add to this podcast. I will put them on the show notes. If there's anything you want to just tell people, any connections, I don't know if you have any links to anything that you want them to know about.
Yeah, we can do that. I can put a little information for people that are looking for, okay, so I've heard you say multiple times, qualified financial planner. What does that mean? And that can look like different things in different parts of the country, but there are some minimum standards that you want to make sure that your financial planner has. And then you want to be looking for reputable people and reputable companies to work with. Different companies are going to have different fees. And so just making sure that you're choosing a company that you trust and choosing a person that you trust. So we can give some tips in the show notes about that.
Perfect. Thank you very much. And we will see you guys again soon. Bye. Thank you for joining us on the Fearless Family Health Podcast. Show notes and resources covered in this podcast are available on our website at fearlessfamilyhealth.com. You can also join in on the conversation with other fearless families on our Facebook group, Fearless Family Health. If you like what you hear and want to hear more, please subscribe to upcoming casts and rate us on iTunes. And also, don't forget to share it with your friends so we can all be fearless.